There's a lot of choose your own adventures, right, in
Ooh, I like
2026. I think you could flip a page and end up in a spot where there's continued stress in some of the grain markets. However, we're short enough in some of the supplies in corn, and so it's a great year for corn exports. If things don't work out necessarily, you could see a page where you flip to and there's actually an increase in commodity prices.
Okay.
So we're kind of in this weird pivot zone for the grain sector.
And maybe by commodity, too. Welcome to the Land and Everything Else podcast. I'm Dr. Craig Lemoine. I'm very excited to be joined today by Jackson with Farmer Mac, Jackson Takach. Thank you so much for being here today.
It's a pleasure. Thanks for having me on. We're in Des Moines, Iowa, where everything's happening. So happy to be with you.
It is. And so I don't know if you've been to Land Expo prior. I imagine you have.
Yes. So Farmer Mac's been a sponsor of the event for the last couple of years now. So we're a big supporter of land and everything else, right? So we'll tie back there.
Look, Jackson. I love this.
And, Farmer Mac is a secondary market for agricultural mortgage lending in addition to some other markets that we serve. So land is a big part of that mortgage marketplace. It's a huge part of the balance sheet. So we care a lot about it.
I want to start with our question, and this is for the Everything Else crew that listens in, right? My wealth managers, my RIAs, my insurance folks. Talk to me about what is Farmer Mac? What is it that y'all do, and how do you support the world around us?
Right. So Farmer Mac is a fantastic organization I've been a part of for about 20 years. It's a secondary market for ag mortgage lending.
Okay.
So we were created coming out of the farm crisis of the 1980s. There was a lack of liquidity in the space. The banks were stressed. The farm and ranches were stressed. The farm credit system was stressed. And there was just a lack of liquidity in the entire system. Congress came to the rescue with some bailout money, but they also said, hey, what could help make a better ecosystem for lenders who may be struggling with assets that don't match their asset liability plan. And they said, hey, it would be great if we had a place to sell these mortgages. We could make a lot, farms are long-term in nature. We want to lend against them in long-term so that farmers have great interest rate management, but we have no place to sell that long-term. Like in the resi world, we've got Fannie, we've got Freddie, but in the agricultural world, we don't have.
There's no one to sell it to.
That's right. There's no outlet for capital and liquidity for the banks. And so that's where Farmer Mac was born. And since that time, 1987, 1988, we have been building that secondary market to create a fluid, easy place for ag bankers to be able to come, originate mortgages, move them into the secondary market, and then they can go make the next mortgage, right? And serve their markets.
You keep liquidity, you keep the market moving, you keep it going forward.
Exactly. And then through the years, we've been able to evolve and serve more markets and take that same great benefit, those same great liquidity enhancing marketplace tools, and apply them to other places like USDA guaranteed lending. So we're a secondary market for that. We do infrastructure lending. So think power, think broadband, think connectivity across. So we're a secondary market for that as well. And we do a lot in the food supply chain as well and try to help make sure that we have a good, stable food supply system. So think about what started as liquidity in farming and ranching space. We've been able to elevate that to more places in that rural economic system.
What's the kind of just getting started on that? I would imagine there are certain profile loans that fit very nicely in the portfolio and probably some that are a little different. Of those ones that fit in nice, what kind of qualifiers, parameters is Farmer Mac looking for here?
Well, first and foremost, we're structured around the land. So there's got to be real estate property, agricultural real estate property involved in there. Right up the fairway, you see, maybe a loan to value of something like 60%.
Okay.
So, not 95% that you might see in the housing markets, but not, something like a 20 or 30%, something low. It's kind of right there in the middle.
Okay.
You're always looking for good cash flow. So I think that's just common of any banking institution. You're going to ask, hey, what's that test of cash flow versus P&I payments? And so you're looking at something like 1.25%. They're very common. And then in the credit space, in the consumer credit scores, anything north of 680, right? So a good credit score being, north of 700, that gets loans done in the secondary market so that lenders can keep that money flowing. We do everything. So there's really no a cookie cutter property that we'll take a look at. It's got to be ag producing or capable of producing agriculture. However, we do everything from alfalfa to zucchini, right?
Yeah.
The old A to Z there.
That's nice.
And we see, that. I've seen requests myself. I used to underwrite a little bit, kind of dabbled in the credit space in my career here at Farmer Mac. Loans in Hawaii, guava farms, organic guava farms in Hawaii, or Texas, a large cattle ranch in Texas, right? So everything in between. And that's really an interesting spot to be able to have so much expertise that we can pivot. Like our underwriters are really just experts at looking at an operation, understanding its inputs, outputs, marketplaces, what's going to stress the borrower, what's good for that marketplace, and being able to assess that risk. I'd say underwriters on a given day are going to look at 10 different types of properties.
How on earth how are they able to assess things as wild as a small guava farm and a cattle ranch? Like legitimately so. Is it training? Is it education? How do they know that? Or are they just very good at looking at P&Ls and that kind of thing?
Yeah, I think a lot of it is understanding of what drives risk, right? Okay. So there's going to be market specific stuff, but there's also general, overall leverage ratios or you look at the history of what Farmer Mac underwrites to, and largely what the Farm Credit System and other banking institutions underwrite to. It's well trodden. The farm financial standards have been really well established and I think well designed such that they kind of understand the high level stuff. And then it's all about asking those questions, that relationship with the banker.
So they get very good at that gratification.
Exactly. And our partners in the origination space, so they're the ones who are really boots on the ground working with the borrowers.
Yeah.
They're asking those great questions and they're getting to know that customer. They may bank them already on the operating side or they have other relationships with that borrower. And so they know the operation.
Sure.
And then it's a really great...
so then you're talking with the lender. If the lender needs to get more information from the customer, they can do that. But basically the lenders over time get good at knowing how to do this correctly.
Absolutely. There's a great relationship between our teams and their teams and then how they approach the marketplace with the borrowers.
Okay. Well, let's pivot for a minute and I want to capture kind of the last 5 or 6 years from an economic standpoint and kind of run by you what that meant for farmers, what that meant for you guys. So we go into COVID and from sort of a residential standpoint, we're going to boost this economy, right? And so we're going to do everything from PPP loans to cutting interest rates to incentivizing people to go out and spend, right? Because I think that first 8 months of COVID, I think the government was very worried about people sort of curbing spending and the economy falling. So we really stimulated the heck out of this thing. But at that point, interest rates do drop, right? Probably historic lows at some point. So what was it like then? Like, what was that period like? I'd love to get some thoughts there.
It was a really dynamic, really fluid, every day, different piece of information. We were having regular calls across the organization just to say like, hey, what do we think what do we think comes next?
Okay.
So it was very dynamic, but really, I think there was a lot of concern coming off the 2018-19 farm cycle that there was going to be a lot of stress because commodity prices were low. There was a great deal of stress already sort of brewing in the farm space. So
this wasn't helping.
2020, I mean, I tell you what, I think my blood pressure probably set a new record high several days during that, maybe 3 months. And then we started to look at, well, hey, maybe there's some opportunities here for farmers. Interest rates come down rapidly. A lot of quantitative easing, a lot of, flight to quality. And so we started talking more and more to our banking and lending partners about this is an opportunity to lend.
It really was.
Right? You could refinance.
If I go back in time, you look at all the opportunities on the table then.
Right. Exactly. We saw people refinancing 6, 7, 8% mortgage rates down to 4, 3.
I bet that took a lot of pressure off the farm too.
It absolutely did. I mean, they could save on average, we were looking at something like $80,000 that a farm operation could then take out of their P&L over the course of 2 or 3 years and really sharpen the pencil on that operation. And that saved a lot of money. And it was a great move for interest rate risk because now maybe the farmer was doing a 3-year resetting product. So every 3 years they get a new rate. Well, now they had a 30-year fixed, and they were able to lock it in at 3.5% or 4%. That creates a lot of certainty and really helps manage that balance sheet risk for the farmer. So that really started happening in mid-2020. And then what we saw, I hate to say I called it, but I kind of called it. I said, hey, look, this commodity super cycle could really run, right? Okay. We were seeing inflation start to pick up.
Sure.
We were seeing the dollar start to weaken as we influenced and put a lot of money out into the world.
And commodities are a fairly safe harbor in inflationary periods.
Exactly right. So what happens? All of a sudden, corn, soybeans, wheat all start to increase. And then that cured a lot of the issues that the farmers had in terms of, well, I had too much corn in storage. Well, now I have a better price. I can market it at a better price. So the ag economy really turned hard in 21 and 22. And then you saw, disruptions in Ukraine due to the Russia-Ukraine war. And that sent the markets even higher.
Yes.
Right. So all of a sudden, the ag economy is booming. We thought it was going to be a complete crash in 2020 with all the uncertainty around COVID.
Of course. Yeah.
And then you flip it to one of the best ag economies in the history of the U.S. agriculture. So it was it was a roller coaster.
A lot in a short period of time. Oh my goodness.
Yeah.
Well, now I'm going to march the clock forward a little bit, right? I'm marching the clock forward. And there's actually two conversation points I'd like to get into here. But let's say now we start saying, oh, there sure is a lot of cash out there. Maybe we raise some rates. Oh my gosh, inflation is taking off. We're going to raise some rates. So as you've seen rates inch up, and then now I would say flatten and maybe ease at 50 bips or maybe over time out of the total cuts. But how did that sort of interest rate rising impact everything in your world?
It was very similar in the farmland markets as to the real estate market. So everyone who had a mortgage at 3.5% was like, I'm not doing nothing.
Yeah.
I'm not listing my house. I'm not moving. I'm going nowhere.
So same in the farm space.
It was a very similar reaction. It was, why would I leave this great rate? I've refinanced at the Farm Credit System or through a bank and through Farmer Mac, wherever. I don't want to touch that.
Okay.
And so the markets kind of seized up. There wasn't a lot of land for sale. And that sent prices going up, right? Supply goes down, price goes up, right?
Absolutely.
Classic economic relationship.
Classic, yes.
And so even though interest rates were going up, a lot of people are scratching their head going like, wait a minute, interest rates go up, shouldn't price go down? And the opposite happened.
The opposite was happening because there's less land going on the market because people are locked in at these lower rates.
Exactly right.
Yeah.
So we still saw there were still deals being done, new purchases happening, but refinances went to zero. Almost at that time because you couldn't get better than 4%. So
especially once it first started hiking, you're going to have very few refinances.
That's right. Yeah. And so things kind of ground to a halt in the entire ecosystem. And that started to unlock after about 3 years. So we get to 2025 and all of a sudden rates have come down. We took a little bit of air out of the balloon. Interest rates came down on the short end. They came down a little bit in the long end too. And all of a sudden people start to transact again, right? Okay. So farms, a mentor once told me that every 7 years a farmer's doing something. Right. Okay. There is no, in the housing world, people can lock in and they could sit in one house for 10, 20, 30 years. In the ag space, farmers tend to want to do something with their balance sheet, buy new land, trade a piece of it off, sell a piece, give it to a family member. And it was just a matter of time before you started to see more activity. And then 2025 was a very active year. Interest rates came down just enough to unlock.
Just enough to get some more people interested. I love that. So let's talk a little bit about longer term trend. One of the things that we've talked about at the Land Expo today and yesterday too, was a little bit about you've had really a substantial increase in acre value in the Midwest, especially in row crops. And I would imagine if I was a farmer holding onto this land, right, and at first it's maybe 500, then it's 5,000, then 10,000, 20,000. Am I going back to pull equity out, or is that more of a consumer housing dynamic?
There is still some equity coming out. So I think it depends on the nature of the farmer, who's owning the land, what they're trying to do. If they're trying to farm, what we've seen is as the costs to farming have gone up, people have tapped the equity to help right-size the balance sheet. When they've got high commodity prices, they can sort of cash flow the operation, the production. But when that comes back down, they might tap equity in order to right-size working capital and have a little bit of cash on hand. So that's what's been happening in 25. We're seeing that equity come out in the form of just a second mortgage or maybe in a first mortgage. Maybe they didn't have any debt. But there's also like farm equity lines of credit. So that can be tapped
kind
against.
Kind of like a HELOC.
Exactly.
Farm equity line.
Exactly. That's one of the products that Farmer Mac offers our originators. And then you see them tap that when they need a little bit of extra cash and then pay it back when they don't. Right.
Okay.
And so
that's more just a line of credit.
Exactly. And it's tied to your real estate. So you get to be able to not have to apply every year for that.
Yeah,
for that
it's
product.
tied to your land.
Exactly.
So
exactly. So there's definitely a lot of tapping of equity. Maybe not as much as maybe in the housing space, but farmers, when they need it, they have access to it, and it makes a big difference.
So when you see, I don't think we're seeing disruptions in banking, but I imagine in 2008 you had a lot of disruptions.
That's right.
In banking. At what point then were you with them in the 2008 crisis?
I was. I started in 05.
What on earth was that like?
Well, similar to the, sort of COVID uncertainty level. I mean, there was a new story unfolding every day
There was.
in that 2008,
Started with Lehman
2009.
Brothers and just
Exactly.
went from there.
I was actually traveling when all the news started to break about the Lehman Brothers, and we were in the middle of a loan review at another institution reviewing, I don't know, $1 billion pool, and they immediately called us and said, "Yeah, we're putting the kibosh on this because we don't know what tomorrow's going to be like."
That's fair.
So it was again, super dynamic,
Yeah.
very unusual period.
Yes.
And we had to, really pivot on some strategies right at that time in order to continue to be a solvent institution, right? So we sailed through it, Nittany conservatorship, like our
Like some of
our
peers.
our other peers in the GSE space. But it was hard, and I think our executive team worked really hard to make sure that we had the right path forward. And since then, I'm happy to say we've tripled in size and really excelled as an organization. But it was a tough environment with a lot of uncertainty and twists and turns. A lot of pizza boxes, like in the mornings you get to work, you see all these pizza boxes. You're like, oh, it must have been a late night.
Must have been a late night last night. Well, that's good. Can we talk just a little bit about where would you say, and this is not my specialty area, but I do think people might want to hear you talk about it.
Sure.
When we saw kind of the tariffs of 2024 and maybe some impact on the indirect impact on commodity prices.
Sure.
Right. Is that a worrisome indicator for farmers? Are we working through that, or where are we at from the perspective of you working with lenders?
Oh, I think it's worrisome. I mean, exports bring a lot of value to U.S. Agricultural producers. We make way more food in this country than we could possibly consume here. So about 1 in 4 to 5, depending on how you count it up, of the farmers' take-home pay comes from a foreign market. So I think the initial blast was, I like the way this sounds, right? I think there should be fair trade. However, I don't like when I can't sell my goods to the people I've been selling my goods to.
Right.
So a lot of dislocation. It was a lot of isolation with soybeans, cotton, and rice.
Okay.
So if you're in the Delta,
the 3 bigger considerations there.
Yeah,
that's Delta issues, right?
Right, exactly. So when you look at the bankruptcy numbers, farm bankruptcy chapter 12s, there was a huge spike in the earlier part of 25 in that area,
in the Delta area,
because in Iowa they can grow hogs, right? Or there's other things that can sort of offset. They're not exposed to maybe 1 or 2 export markets. Some of those Delta producers, they're really exposed to shipments to China, buyers overseas. And when those started to disconnect, we weren't selling anything. That was a lot of pressure.
That is a lot of pressure. I love that perspective. I think our audience too, right? On that note. So we're at the beginning of 2026 as we're shooting this episode. It may air a little later, but we're there. What kind of, with you talking with lenders and farmers, what do you see 2026 hold in the space?
There's a lot of choose your own adventures, right, in 2026.
Ooh, I like
I think you could flip a page and end up in a spot where there's continued stress in some of the grain markets. However, we're short enough in some of the supplies in corn, and so it's a great year for corn exports. If things don't work out necessarily, you could see a page where you flip to and there's actually an increase in commodity prices.
Okay.
So we're kind of in this weird pivot zone for the grain sector.
And maybe by commodity too.
Very much so. Right. You could see maybe more biofuel demand come through with renewable-based diesels. That could drive more soybean crush. And we're not worried about China as much because we're crushing the soybean here, not sending it in bulk overseas. However, if it doesn't develop, then you're stuck with a lot of extra soybeans.
Right.
Proteins, I think, are going to be another great year. I think there's a great base of demand for beef, poultry, pork.
Oh, absolutely.
So I'm looking at those as a continuation. It's still expensive to raise the heartbeats across the country, but the demand is there. Consumers are going to really continue to support it. Fruits and vegetables, I think, are going to have a good year too. So let's not forget about our friends in the smile states, right? They grow lots of things that we eat on the outsides of our grocery stores. There's a renewed focus on nutrient density and what is in your food. So I think that's going to bode well for specialty crop producers as well. So there's a lot of positives.
Yep.
I worry a little about the cost of inputs.
Okay.
So I think about how much does it cost to raise a bushel of soybeans or corn, and those costs don't come down very quickly.
Right.
So that's going to be the really difficult part for a lot of producers is how do I afford to get a crop in the ground? So that's going to be something we got to work through and find ways to make it more cheap, more easy to grow some of the crops that we rely on.
And that's where I think, you start seeing bigger and bigger economies of scale. And I do think that helps with your input conversation.
Yeah.
Right? Move things down a little bit.
Absolutely.
So fantastic. Well, I've really enjoyed talking with you, and I think from our audience and student standpoint, just A+.
Hey.
Like we're gonna take pieces of this and we're gonna chop that up and use it in the classroom. And oh my goodness, thank you so much for your time.
It's my pleasure, and have me back anytime.
We will.
All
Well,
right.
thanks, man.
Thank
It was
you.
great.